This is the Asia Trade. I'm Paul Allen in Sydney, where the markets have just opened.
And I'm Haidi Stroud-Watts. The top stories this hour. Asian stocks are set to slide as the S&P 500 falls into its first correction in almost 2 years amid a 3-week rout. Treasuries climb amid growing concerns over Donald Trump's widening trade war.
And President Trump now threatening to impose 200% tariffs on European wine and champagne after the EU's plan to tax American whiskey.
And an exclusive interview with AIA's Group CFO after the firm announced a new share buyback of up to $1.6 billion. We'll take a look. This is a picture when it comes to US futures after what was a milestone session, if you can call it that. It fell 1.4% for the S&P 500 on the day, bringing that 3-week rout to a level that, of course, we see meeting the technical threshold for a correction. We're down more than 6% so far this year. That's a wipeout of about $5 trillion in market cap since the peak in February. And, of course, so much of this has been ongoing concern over the volatility driven by President Trump's trade policy and some of the other domestic economic policies and the impact on economic growth and on the inflation outlook as well. At the moment, we're seeing S&P futures picking up a little bit from that downside, about 0.5%. Nasdaq 100 futures also higher by about 0.6% there as well. But overall, it's we've seen 16 trading sessions to tumble by this magnitude from that February 19th high. This is the 7th fastest correction in records going back to 1929, and it's interesting in terms of the sort of political policy volatility that we've been talking about. 3 out of the 7 fastest drawdowns of this magnitude have actually happened under President Trump in 2018, 2022, and now in 2025. Take a look at oil as well, which is interesting because we have been watching, of course, just that downside when it comes to concerns over the demand outlook for not just the US, but of course China as well, but a lot of the trade issues hitting oil at the moment. But we are seeing oil a little bit of an upside trading in New York, 0.4%. We did see some volatility in that session as well, with the IEA saying that the trade war does pose risks to the global demand picture. They're expecting that supply will exceed demand by some 600 barrels a year, and that's really contributing to that bearish outlook there.
Yeah, that the drill baby drill narrative around oil as well is starting to get something of a reality check. I mean, we have heard from the wildcatter billionaire Harold Hamm. He's a major donor to President Trump, by the way. He disagrees with the Energy Secretary Chris Wright's claim that U.S. companies can increase production at $50 a barrel. Shale drilling is getting more expensive. The assets that remain are declining in quality, and Hamm says, look, at $50 a barrel, U.S. drillers cannot drill baby drill. It is just not economically viable. So there's a number of factors at play here in terms of what's happening in the crude market. But that stock market action today, I mean, superlatives abound. I think the sell down now is something like $5 trillion in value, wiped from the index. The gauge of mega cap tech down 2.5% today, something like 22% for the Mag 7 down since the peak as well. So really, really heavy selling. But the former US Treasury Secretary, Steven Mnuchin, he was Trump's Treasury Secretary, says, look, nothing to see here. It's all perfectly normal.
Yeah, it'll be very interesting as we see, of course, this Friday session in Asia looking like it's going to replicate some of those losses. And in fact, we've got a number of Asian markets that are already near or in correction territory. And of course, the latest missive, if you will, that has been threatening markets has been this threat from President Trump to impose a 200% tariff on European alcohol. That's after the EU's plan to tax American whiskey exports. The bloc's top diplomat says they don't want a trade war, but will not hesitate to defend their interests.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests.
For more, Bloomberg's White House and politics reporter Kate Sullivan joins us now from Washington. So these tariffs, counter-tariffs, reciprocal tariffs are really starting to spiral now.
Yes, I get that. think these latest threats from Trump really show just how fast things can escalate and how quick countries are to retaliate in the current climate that we're in amid this trade war. So as you mentioned, Trump now says he's going to impose a 200% tariff on wine and champagne and other alcoholic beverages from Europe. And he says the only reason he's doing that is because of the EU's plans to put a 50% tax on imports of U.S.-produced whiskey. So you're seeing alcohol really becoming a friction point here in this trade war. And in Trump's announcement on social media, he also continued to take shots at the EU, saying it was one of the most hostile and abusive taxing and tariffing authorities in the world, really escalating this kind of rhetoric we've heard from him about the European Union. But there's, of course, so much back and forth here because that whiskey tax that he's referencing that the EU is imposing was put in place because it was a retaliatory tariff because of Trump's steel and aluminum tariffs that he announced this week. He's placing a 25% tariff on all steel and aluminum imports. So, where we're at right now is if that whiskey tariff stays, we're looking at these new tariffs all hitting on April 1st, which is, of course, just one day before the large-scale, wide-ranging reciprocal tariffs that Trump has planned.
Yeah, this cycle of tariff reprisals was just so predictable. But is President Trump showing any signs of backing off from any of these trade war threats?
At the moment, we are not seeing any signs of that. Trump has been very steadfast in defending these tariffs and has completely dismissed the market volatility, says that investors are going to see gains and that domestic producers are going to benefit. We actually heard him today in the Oval Office say, I'm not going to bend at all. That is a direct quote from him. And he said, we've been ripped off for years and we're not going to be anymore. So, we heard him in the Oval defending it today. We heard him defending them to CEOs at a roundtable this week. But it's been such a roller coaster, as you know, these past few weeks with the tariffs because of his unpredictable on-again, off-again approach. So it's very hard to say at the moment which tariffs are ultimately going to stick. But one thing that hasn't changed is Trump's defense of them.
There's a lot of other stuff going on, right, ranging from geopolitical conversations around the Ukraine ceasefire, but also the domestic debt ceiling debate. Did we get any update on that?
It sounds as if we have had some difficulties with Kate Sullivan there. That was Bloomberg White House and politics reporter Kate Sullivan. Let's get a little bit more on market impact. Our executive editor for Asia Markets, Paul Dobson, joins us now from Singapore. So, Paul, huge selling today again that we've seen for US markets. S&P now in correction, as we mentioned. But where are the dip buyers in all of this? Is there any evidence that any investors are using this to load up?
Interesting to bring that up, Paul. Good morning. So it does seem that there is a crowd or a cohort of retail investors that are still putting money into the market, trying to capitalize on the recent downdraft. But they're not getting very far because the prices keep going down. So we're seeing more of the higher risk ETFs, for example, or the other speculative corners of the market really getting crushed. So that's making it very difficult for them to hang on to those speculative efforts to sort of find where that dip is and load back up again. I think what we've seen more generally with the very large investors is a very big downsizing of risk tolerance over the last 10 days, which has seen them cutting back positions right across the board, all the way from the very largest pod shops down to and the rest of the world. And I think that that speaks to this idea that it becomes a little bit self-perpetuating as prices fall and people scale back. So volatility rises, so people's risk tolerance comes off again, and it causes a little bit more retrenchment. So at the moment, that can become a little bit self-fulfilling. I would say on the flip side of that, though, these are not hugely dramatic, terrible, terrifying drops right at the moment. Monday was a pretty brutal day, but since then, it's been sort of a little bit more of a gradual decline, and that does talk to this idea that it's not a complete flush out, and there are people trying to find where that bottom is. But at the moment, that sales sort of force and momentum is overpowering it.
Looks like in the meantime the bid for bonds has no other choice but to continue.
Yeah, but again, not huge moves higher in treasuries either. You know, I think it was about a 4 basis point decline in treasuries overnight. Where the market seems to be looking for that haven is still gold. A lot of positivity there. Record highs hit this week again. The bond market, I think, you know, part of the concern is that the Federal Reserve is not giving us a strong clue that it's going to step in and help anytime soon. In fact, you know, before they went into a quiet period, most of what we heard from them is this idea that at the moment they think interest rates are calibrated just about right for the economy and that they don't need to rush and they don't want to step in right away. And they may have in the back of their mind, you know, that this back and forth on the tariffs is so uncertain that they will look through that a little bit and will wait and see for a little bit more where that goes. So without Fed cuts, you don't have that real compulsion to push interest rates a lot lower or to buy into treasuries as your haven. It seems like people looking elsewhere really to find other opportunities maybe in the market as well, in Europe, in China, where we've seen some strength recently, rather than pouring it all into the US Treasury market.
Executive Editor for Asia Markets, Paul Dobson there. Well, coming up on the Asia Trade, AIA Group CFO Garth Jones will be joining us exclusively to talk about the company's latest earnings. MPower Partners also sharing their plans on how to boost female representation in Japan's venture funding space. Plus, we get investment strategy with BlackRock. They're expecting continued market volatility over the next few months. This is Bloomberg. Well, AIA will start a $1.6 billion share buyback after reporting a 17% growth in new business value last year that missed estimates. The firm's group CFO, Garth Jones, is now exclusively. And Garth, talk us through some of the sort of strengths and bright spots, but also weaknesses that you saw in that result and how the broader environment, both, of course, regionally and globally, might be playing into that.
Yeah, we saw an excellent set of results by any measure in 2024. We saw double-digit growth in our key metrics for new business growth, for earnings, and for cash generation. Our value of new business, our key growth measure, grew by 18%. And importantly, we had double-digit growth across all our market segments. It's a broad-based growth. Our operating profit after tax was up 12% per share, and our underlying free surplus generation also grew by double digits. So with that, we've seen an increase in the final dividend of 10% per share, and as the headline says, a $1.6 billion additional share buyback. I think that reflects the strong momentum in the business. We've seen growth across the portfolio. We've seen recruitment be very strong in the agency force. Recruitment was up by 18% in 2024. And with that, we see the strong momentum building into 2025. So we remain confident in the outlook. And we're very well placed to capitalize on all the opportunities available to us.
Can you tell us about how the China part of the business is going, how margin expansion is looking? Last year was pretty good, and what sort of expansion and strategic plans do you see for China?
Yeah, we're obviously very excited about our China business, which goes from strength to strength. We have a differentiated business in China, which is focused on the wealthiest parts of the geography, the biggest cities in China, and also the wealthiest segments, the more affluent customers. That makes them more resilient through economic cycles. Our business is also very well diversified. More than half our earnings come from insurance and fee-based sources. And our business is focused both on protection and long-term savings. So what we've seen is growth in the agency force again. The agency grew. Recruitment has been strong. We've seen growth in the number of new customers. And the business is going from strength to strength over time. Importantly, we've also seen growth in our geography. We started off with our original 5 geographies, which continue to grow, and we've deepened our presence there. We had 5 new geographies from 2019. They've been growing very well. They grew at 27%. The business overall grew by 20%, so you can see they're growing even faster than the rest of the portfolio there. And our new businesses in the provinces we've just been awarded. We were awarded 4 new provinces in 2024, and we're just starting operations there. So you can see there's tremendous headroom for growth in China. We remain extremely excited about the prospects there.
You're also projecting strong growth in Hong Kong. What's driving demand in that market?
Yeah, our business in Hong Kong grew by 23% to a record high. We've seen growth in the mainland Chinese visitor segment. That grew by 22%, and there's robust demand there. We also saw growth in the domestic segment. That was up by 24%. And we've seen an increasing proportion of that business from new migrants to Hong Kong, from mainland China particularly, but from other areas, as Hong Kong develops a further talent pool. So with that, we see tremendous growth in the business. We also see growth, as I say, in recruitment. Recruitment was up 18%. And we've seen strong growth in our business through our partners, also through Citibank and Bank of East Asia. So that business is extremely well placed, and it's the biggest contributor to the new business in 2024. We can see that business continuing to have a lot of headroom for growth into the future.
Just returning to the dividend, as you say, up by 10%, nearly $1.31 Hong Kong, and a buyback of $1.6 billion. How long do you anticipate this policy of returning money to shareholders continuing? And is there any internal discussion about deploying capital elsewhere, perhaps some M&A?
We set out our capital management policy, our enhanced capital management policy last year. That aims to return 75% of our net free surplus generation to shareholders. And we also say we'd look at our balance sheet regularly to look at whether we have excess capital that we can also return to shareholders. And from that, you see the increase in the dividend. You said 10% final dividend increase, and the $1.6 billion additional buyback. We've returned now $18.2 billion to shareholders over the last 3 years, $4 billion in respect of 2024. So we continue to see how we're not only delivering returns on the business through growing the business, but also being more efficient in the way we deploy capital. And with that, you see an increase in the return on equity, and you see strong returns to shareholders. We continue to look at ways in which we can deploy capital around the region. We're very focused on Asia. And we'll continue to deploy capital in the best way possible, both through organic growth. You've seen, again, tremendous organic growth in the business and strong momentum. And there will be occasionally some inorganic activity that we add to it as well that will add further growth to the portfolio.
What's the strategic outlook and plan when it comes to private market opportunities?
Well, what we see is that there are opportunities for investment in private equity, private credit, and so on, as well as in public markets. The vast majority of our portfolio is in fixed income investments to match our long-term liabilities. But we see that we can add additional returns to our policyholders, particularly our participating policyholders, who share in the gains that we make over a longer period of time and can invest in a broader range of assets. Those returns look very attractive over a long period, and clearly we will continue to invest in those and provide the best returns we can for our policyholders.
Garth, a lot of talk in markets at the moment about the role of AI. I'm just wondering what you're doing there to put the AI in the AIA.
Well, we believe that AI will transform our industry, and with that we will see better outcomes for our customers, for our agents, and for our shareholders. We've already deployed a lot of AI already, actually, in our business. One thing that's important to note is that we invested heavily in technology over the last few years, and with that we've not only got the infrastructure, but we've also got our data in the right form so that we can leverage AI to its fullest extent. We've already have around 50 use cases, and they're already producing substantial benefits to us. A good example is our call centers, where the AI summarizes the call center conversation. And with that, we've seen our response rates reduced by about a half. So we can see better service to policyholders, a more efficient business, and as I say, better returns to shareholders.
All right, Garth Jones, AIA Group CFO, thank you so much for joining us today. We've got more ahead on the Asia trade. This is Bloomberg.
tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold, waiting for more information. Trump administration is making the matter worse because not only are they putting tariffs in place that are much larger than they did during the first term, they're doing it in a very haphazard, irregular way, which is creating a lot of uncertainty.
Our Bloomberg Opinion columnist Bill Dudley there talking about the impact and risk of Trump's tariffs on markets, of which are pretty clear with that equity market correction for the S&P 500. But take a look at how we're viewing the FX side of things. And it was interesting. We had some oscillations in the dollar, but broadly the Bloomberg Dollar Index was stronger in the overnight session. A lot of those trade tariff risks remaining in focus. It did, though, pair some of those gains after one report showing that US wholesale inflation stagnated in February. In Asia, we did see that outperformance in the yen. The euro, though, no longer being seen as overbought.
Well, the EU's top diplomat Kaja Kallas says the European Union is ready to defend its interests. She spoke with Bloomberg after President Trump threatened 200% tariffs on the bloc's alcoholic products following the EU's plan to tax American whiskey exports.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests. But like I say, in the end, eventually the consumers get to pay higher prices, and that is not in the interest of anybody. So we really try to avoid these things, but of course we see this news coming all the time. I think right now it's important to keep cool heads because we see the statements, and then what really matters is the actual steps, the legal acts that are done, and then we are also ready to react.
A stupid question or a basic one, but are you confident you know what the U.S. wants when it comes to this trade war? As you watch all of these salvos and escalations, do you know what you could do or might do to appease the President of the United States and end the war that started a few weeks ago?
Well, of course, you have to ask the President of the United States what is their goal regarding this. But what they have been or what they have been saying out is that there is a trade deficit between our countries. It is of course not that big, and we can address this in a different way. But it is how it is. Like I say, we keep a cool head, and of course we are ready to act and defend our interests when we need to.
That was the European Commission's Vice President and High Representative for Foreign Affairs and Security Policy, Kaja Kallas there. More ahead on the Asia trade. This is Bloomberg.
Let's take a look at how some key commodities are trading at the moment. We do have iron ore prices ticking up ever so slightly, 102.50 at the moment for futures traded out of Singapore. The copper price holding up as well. Interesting moves for the oil price as well. We're seeing some modest gains for New York crude, although Brent has slipped back below $70 per barrel. The International Energy Agency is also trimming its outlook for consumption growth due to, you guessed it, the trade war.
Also geopolitics at play as well, Paul. At the moment, Russian President Vladimir Putin saying he wants to discuss the proposed Ukraine ceasefire with US President Donald Trump. However, he warns that any truce should lead to a long-term resolution of the war. For more, let's bring in Bloomberg's Michael Heath. And we've been saying how the ball is in Putin's court at the moment. It was interesting. We were just listening to our conversation with the foreign policy chief for the EU, Kaja Kallas, and she's a known Russia hawk, and she's saying, look, none of these ceasefires will last, right? There's a lot of scepticism there.
Yeah, and look, I think even what Vladimir Putin said, I mean, there's just a real sense of obfuscation almost about it. This comment that it needs to lead to real peace. Well, that's what the whole purpose of the ceasefire is, so that they can negotiate that. So look, you get the sense that he's playing for time because while the ball is in Russia's court here internationally, and he doesn't want to be caught out as the one who's standing in the way of peace. His forces seem to be making up a bit of ground, and they would dearly like to expel Ukraine from the Russian territory that it has managed to capture, which it wanted to use as a bargaining chip in any peace negotiations. He'd really like to have that removed from Ukraine's grasp before there is serious negotiation. So, look, we'll have to see. I mean, President Zelensky of Ukraine sort of ridiculed what Putin was saying, and basically that Putin had started all this and really doesn't want peace because he's just interested in killing Ukrainians, which is sort of extreme, but you can understand where he's coming from. I mean, the general sense among people who are suspicious of Russia is that he'll drag this out as long as possible.
And of course, Putin does have a history of violating ceasefire agreements. Can there be a credible deal without at least European troops present in Ukraine?
Yeah, absolutely not, Paul. I mean, what we've seen is Russia basically is surrounded by ceasefires or frozen conflicts, this sort of stuff, whether it's in Georgia, whether it's in the Moldova, these other areas. It does. And the reason it doesn't want NATO or European peacekeepers is that that would constrain its options here. We know that it's run down a lot of its Soviet-era arsenal and that sort of thing. So the opportunity to have a bit of a ceasefire and restock and have another go at this probably is playing in the back of their minds. And that's why Ukraine and Europe in general will insist on NATO forces being involved on the ground there, mainly because Putin has a line, and it's fairly clear from his 25 years in power, he doesn't touch anything to do with NATO because of Article 5, that they'll all respond. Whatever President Trump says, the rule is that everyone has to run in to defend somebody. So if NATO troops are attacked, it really would raise questions about whether Russia is, in conflict with NATO there. Putin has said he wants Chinese forces, etc., who would be much more probably sympathetic or he'd say even-handed, but probably more sympathetic to the Russian case. So that's going to be a really, really interesting one. I mean, it's a very, very difficult agreement to actually get sorted out because there's just such conflicting situations here on both sides.
And of course, there's always an economic stake, right? Even Putin hinting at the possibility of economic energy cooperation. We know that the Europeans are seeing that interest in Gazprom. At the same time, we're seeing a tightening of energy payments sanctions by the US on Russia. Yeah, well, so what's happened is a Treasury... It's a waiver that basically allows Russian banks to access the financial system to process energy payments from Russia, and that waiver is sort of there to allow countries that sort of need these transactions to happen. It's almost like it sort of has slipped through the cracks in a way. It's not like the US has sort of imposed new ones. They just haven't allowed that. They haven't extended the waiver. So that may well happen. It's unclear. But as to Gazprom, that's very interesting. And Gazprom has long been seen as sort of a private arm of Russian foreign policy. I mean, it's this vast hydrocarbon company, and there's a lot of money involved in that. And Europe, you'd imagine, would be very, very... I mean, what the war showed Europe is that it can't rely on Gazprom, it can't rely on Russia here. So it'd be interesting to see what the US is looking at there, because the US obviously produces a lot of hydrocarbons itself these days. So how that unfolds will be very, very curious.
Well, there's a G7 foreign ministers meeting happening in Quebec at the moment. I imagine the mood is somewhat uneasy. What are the odds of achieving consensus on anything?
Yeah, look, pretty close to zero is from our reporting at least, Paul. And one of the things is that obviously the other countries in the G7 want to be harder on Russia, and we saw this, earlier in February when it was the third anniversary of the invasion. The US was vetoing in the UN condemnation of Russia, and the same thing seems to be happening again in the G7. The charitable explanation is that the US is looking not to provoke Russia when it's in such sensitive negotiations, trying to get this ceasefire up. Perhaps the less charitable one is that President Donald Trump is not very happy with any American allies at the moment, is not particularly interested in international institutions, and a couple of sources have told Bloomberg that it looks like the US is just there to just to make sure there is no consensus. Now, Marco Rubio, the Secretary of State, is one of the more conventional members of the Trump cabinet. And probably he would very much like to have an agreement, but it seems like we won't get anything out of that.
Makes Michael Heath there with the latest there. Well, authorities in South Korea have ramped up security measures around the Constitutional Court ahead of a ruling on whether to permanently dismiss President Yoon Suk-yeol. Our economy and government reporter Soo-hyang joins us in Seoul. And what's sort of the latest in terms of when we're expecting that ruling, what we might be expecting, and clearly a high degree of tension and expectation that we could see a repeat of protests on both sides?
The court was widely expected to deliver a ruling sometime this week, but it looks pretty clear at this point that the ruling will be pushed back until at least next week. The court announces the ruling date just days in advance, so we don't know exactly when Yoon's fate will be decided. What we do know is that it's taking more time than the past impeachment cases where the justices deliver a ruling within 2 weeks since their final hearing. If 6 or more judges agree to uphold the impeachment, Yoon will be immediately removed from office. If judges decide to reject the impeachment, Yoon will get his presidential powers back and return to office.
But what could potentially be next? Could Yoon appeal if he is unsuccessful?
The ruling is final and takes effect immediately. So if he's booted out from the office, he won't have a chance to appeal. And a presidential election will be taking place within 60 days. Either way, South Korea will likely have to remain in poor position to deal with tariff threats coming from Donald Trump, at least for the coming months. And analysts say a likely worst case scenario is if the court dismisses the impeachment, at least for the market, prolonging the political chaos and putting Yoon, who's deeply unpopular leader in office, to lead the country. Now, if a snap election is held, Lee Jae-myung, the opposition leader, is the front runner, and there is clearly no front runner from the Yoon's conservative camp at this moment.
I do wonder what public sentiment is at right now, particularly at a time when we're seeing vulnerability in the economy, the impact of this political drama on the fiscal side, and the ongoing threat of Trump tariffs.
We are actually seeing a sharply divided South Korea right now. We've been seeing street rallies taking place every week since Yoon's impeachment in December, both for and against Yoon. And police are actually ramping up security. They have decided to close schools near the Constitutional Court on the verdict date. They're encouraging companies to allow employees to work from home on the day of the ruling. So we are indeed seeing these risks very high and entering a very critical moment for South Korea right now, with tensions running very high.
Right, economy and government reporter Soo-hyang Choi there. Let's get to some other stories that we're following. A US Senator Democratic leader Chuck Schumer is dropping his threat to block a Republican spending bill. The move opens the way to avoid a US government shutdown on Saturday. Democrats and Republicans have been engaged in a standoff over Democratic insistence that a spending package include some restraints on Elon Musk's federal cost-cutting crusade. Portugal will hold an early election on May the 18th after the government was ousted in a confidence vote. The collapse may delay some key decisions, including infrastructure investment and defence spending. And this will be the country's third election in just 3 years. Prime Minister Luis Montenegro is expected to seek re-election. Former Philippine President Rodrigo Duterte is set to appear before the International Criminal Court later on Friday. Duterte is facing charges for alleged crimes against humanity during his deadly war on drugs. His arrest marks a significant milestone for the ICC and a major political shift in the Philippines, where his daughter is vice president and the Duterte clan enjoys strong support in the country's south.
We'll take a look at how we're trading just 40 minutes into this Friday session here in Australia. A little bit of upside, just sort of pulling away from the cusp, still really on the cusp of that technical correction for the ASX 200 there, given that close of half a percent lower in the previous session. Really could tip closer into that territory if we see a change in sentiment. This has been the first gain that we've seen in 4 sessions for the benchmark, but still we've been sitting at the lowest level since about August 8th. At the moment, we're seeing pretty bifurcated market. Materials seeing gains of about 1.5%, some strength in utilities and real estate there as well, but a lag when it comes to consumer stocks as well as energy, given the uncertainty over the global oil demand and supply outlook there. We also had some words of caution from Australian regulators, really warning about the possibility for a further disorderly environment when it comes to trading. They see the risk of disorderly market corrections given the geopolitical tensions, the international environment being highly uncertain. uncertain and policy uncertainty being magnified, according to the Council of Financial Regulators there. The Aussie dollar sitting pretty unchanged at the moment, 62.86. We had some fluctuations in the trading the dollar, ultimately a little bit stronger, but we did see some of those gains being erased after a softer PPI reading for February in the US. More ahead on the Asia trade, this is Bloomberg. A new fund in Japan is challenging gender inequality. MPower Partners just launched their W-Power Fund, which is dedicated to supporting women, entrepreneurs and startups that offer products and services that promote female empowerment. For more, MPower Partners co-founder and general partner Kathy Matsui joins us now. Kathy, really great to have you back on Bloomberg TV. And we know that your background is so heavily focused on really pushing forward the campaign of women's empowerment and womenomics in Japan, right? Can you give us an idea of how the landscape is at the moment, given the changes that we continue to see in the broader economy?
Absolutely, and thanks for having me back. If you look at what's kind of changed since I first broached the topic of womenomics back in 1999 when I was still at Goldman Sachs, we've seen a phenomenal increase in the percentage of women in this country working outside the home. It used to be Japan had the lowest female labor participation rate in the developed world, and now it is over 70%, exceeding both the United States and Europe. So that's phenomenal. This is a record number of women working outside the home in Japan. Having said that, if you look at the composition or what type of jobs these women are working in, more than half are still working in part-time roles as opposed to full-time ones. Hence, if you look at where we still need to do a lot of work here in Japan, is there's still a dearth of women in leadership or decision-making positions. So, for example, the percentage of women on executive corporate boards or in the parliament is still pales in comparison to the rest of the developed world. So still a work in progress. However, we have definitely made some progress over the last quarter century.
A lot of sort of question marks over what's going on when it comes to the anti-DEI push in the US, the unwinding of a lot of those policies, even at, big banks, including ones that you've worked at. And I do wonder, how do you see this playing out for Japan? Do you see that impact as having overflow, or do you see that as an opportunity to be able to take on some of the investor interest from those who are still dedicated to looking at, equity-driven investment opportunities?
Look, at the end of the day, Japan faces a hard, cold reality, which is its labor force, the workforce population, is going to shrink by over 1/3 by the year 2050. Japan is not in a position, in other words, to relax, to step back from its push to increase the inclusion of all people in its country. So I believe that this is actually a fantastic opportunity for Japan to double down on diversity. And our fund, W Power, that you just highlighted at the beginning, we are Japan's first VC fund dedicated to female founders and businesses that are empowering women. And the reason we did this is, if you look at the landscape, female founders in this country only receive 2% of all venture funding, despite the fact that women account for 34% of all founders. More interesting is we actually did some analysis and looked at the average valuations of different stages of funding rounds, male founders versus female founders. Across the board, without exception, female-founded companies' valuations were lower than that of their male counterparts. Having said that, on exit, the primary exit route in Japan is IPO, as you know. If you look at average IPO valuations relative to the cumulative amount of funds raised, females' valuations of their companies were actually 1.5 times higher than that of their male counterparts. In other words, you can get in at a discount, you can exit at a premium. And So for us, this is a tremendous arbitrage opportunity. We're not doing this for charity or for human rights or all of that. We're doing this because we are financially driven investors, and this is an untapped opportunity that we believe is extremely attractive.
Kathy, is that one of the reasons you're launching the fund now? And can you tell us about some of the projects that you've been putting money into?
Sure. So we actually have our main flagship fund called MPower Fund, which we launched about 4 years ago. It's a $150 million US fund. We have 20 portfolio companies, mainly here in Japan, but also some outside of Japan. And we do not have in this flagship fund any kind of gender lens when we're looking for companies, but it just so happens that 40% of our portfolio in the flagship fund is also female or minority founded companies. It's coincidental. It's not, a deliberate or choice that we're making to seek out minority founders. We believe we're picking the best companies we can possibly find, and that is the outcome. So for us, if you look at the themes that we're looking at, females are running businesses that are deep tech, life science focused. We're also looking at companies where women are running B2B software businesses that are growing very, very rapidly. We have a company that's providing a reskilling platform for millennial women, which is a huge need, as you can imagine, in this country. So it's a very wide gamut of businesses that these women are running. But it's like, it just so happens that they're women. It's not that they're running women-related businesses.
Mm-hmm. Well, you're also getting support from partners like Mitsubishi UFJ Bank, the Japanese government as well. And in terms of the government, is there any more support you'd like to see to give more backing to female entrepreneurs in Japan?
Yes, and I have to say, Tokyo Metropolitan Government, who is one of our backers of WPower Fund, has been a tremendous leader in this arena. But we would like to see more, not just public support, but frankly, private support, because at the end of the day, to move this needle of 2%, we need everybody's involvement and participation. So we need more acceleration programs. We need more networking opportunities for women. And we frankly need just simply more capital. We also need more diversification on our side of the table, which is the venture capital or investor side of the table. And we're making efforts in that space. There's a wonderful organization called Tokyo Women in VC, which I support. And they're trying to increase the number of female decision makers in the venture capital industry here. So there are multiple prongs to attack this problem. But I'm very, very confident, given that opportunity set that I've just described, the opportunity for, really achieving significant financial returns in this market are tremendous.
All right, Kathy Matsui, co-founder and general partner at MPower Partners. Thanks so much for joining us. We have more ahead on the Asia trade. This is Bloomberg.
Do have some breaking news just crossing the Bloomberg. Samsung SDR to sell 2 trillion won of new shares there. We will see that market reaction when trading comes online in Korea in just about 7 minutes' time. They'll be selling 11.8 million new shares according to a regulatory filing. The proceeds for this sale will be used for M&As and capex, with the expected new share price of 169,200 won per share. The current number of shares outstanding is 68.76 million. So one to watch as we get into the start of trading in Korea, Paul.
Well, this weekend, the new Formula One season gets underway in Melbourne with the traditional opener, the Australian Grand Prix. This is not an easy sport for new teams to break into, but there's one Australian tech CEO trying to do just that from a remote mountain base in New Zealand. The scenery is stunning, and so are the cars that shatter the peace. There's no neighbours to complain about the noise here at Mount Lyford. This is where the CEO of ASX-listed Dicker Data set up Roden Cars, a very expensive passion project.
I wouldn't say building cars is necessarily the most profitable business in the world, even if you can be successful.
In 2005, Dicker bought a 1,300-acre farm here and, over time, built a test track and a garage with all the gadgets, including a 3D titanium printer and electrical engineering equipment. The F-Zero hypercar is one of the results. A 4-litre V10 engine, a top speed of 360 kilometres per hour, and a no-rules design philosophy. It looks like something Batman would own.
Well, on the F-Zero, we designed the whole car ourselves, basically. I designed the car completely from scratch. So there's, other than, electrical components and, brake systems and a few other bits and pieces, virtually everything on the car we made here.
Another of Rodin's cars is the FZ, which looks more similar to a Formula One car. It was hoped Rodin would be on the grid for this year's Formula One season, the first team ever from the Southern Hemisphere, turbocharging production and innovation at Rodin's base. But the bid was unsuccessful, a failure that Dicker blames on Formula One politics.
They're not really interested in sporting teams, they're interested in big corporates that can use the sporting side of it as a marketing function. And that's not really sport.
Dicker is refusing to give up on his F1 dream. He admits it's unlikely, but then again, the entire Rodin story so far has been unlikely. Paul Allen, Bloomberg.
Take a look at how we're trading, with Australia extending some of those gains, albeit modest ones, but still keeping away just from the technical correction territory that it has been sort of wavering on the edge of. And of course, we saw that happen when it comes to the S&P 500 overnight. Nikkei futures looking mildly in the green there, and S&P futures a little bit more positive. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. Well, Australia is online and we're seeing a little bit of muted upside, if you will. Perhaps you can characterise it as just stopping short of that technical correction that we've been threatening to fall into when it comes to the ASX 200. And that, of course, would follow the lead of the S&P sliding past at that key level overnight as well. We are seeing still some of that downside pressure, but at the moment, we're seeing Australian stocks up by just about 0.3%. The dollar had been erasing some of those gains after a muted PPI inflation number came through for the US. But of course, so much of the overlay of this is really what's going on with yet more trade tariff threats that we see from President Donald Trump, including the latest when it comes to on the EU and some of these alcohol and whiskey related tariffs and counter tariffs that are being thrown about at this point. Let's take a look at markets that are just coming online this hour. The Nikkei 225 off by just about 0.5% there, or 0.3% as we just come online, as we do have the topics also down by about 0.2% there as well. We're watching the yen as well, given that some of the outperformance we saw in the overnight session has really come through from that yen dollar trade. 147.95 is where we're at. 148 is a level that we're pretty close to. And now I'm watching really bond yields, but the Japan 10-year yield in particular, as is bid up for treasuries, for sovereign bonds more generally, is continuing to be extended, albeit we haven't seen sort of really strong moves even when it comes to treasuries trading there as that haven demand amidst the trade tariff uncertainty continues. Take a look at Korean stocks also coming online. Samsung SDI is one to watch in the session as we see $1.4 billion of new shares on offer for battery projects and potentially M&A funding there as well. Watching some of the other names, including the likes of LG Electronics and Kakao considering a spin-off of the Dome business, and watching some of those other Korean names, as I said, including broadly Samsung as well, with some of the payments on the Galaxy App Store, one of the themes to watch at the moment. The broader cost be off by about 0.3%. We also have, of course, the ongoing political turmoil still playing out as well. We're expecting that sentencing today when it comes to President Yoon's impeachment, expecting large-scale rallies to be taking place, and schools near the Constitutional Court, the new no-fly zone, have been implemented as well there. Let's bring in, for more on these markets, Thomas Tor, who's the head of APAC investment strategy at BlackRock, joining us now. Thomas, great to have you with us. So we live and invest in a time of extraordinary volatility and very quick changes when it comes to news flow, policy direction. How are you navigating this?
Morning. Nice to be back. So yes, a very volatile environment. We expect this to continue for the foreseeable future. I think you basically have U.S. and then you have pretty much everywhere else. And in the U.S., what you see under the surface is a relatively large rotation from growth momentum into value and quality. And you can do that through specific sector or factor funds, or you can move into places like Europe and to some extent China on a global perspective. So when it comes to U.S. specifically, there are things that are working. Fixed income, for example, looks pretty good. Systematic funds, liquid alternatives, these kind of things which are unconstrained and or market neutral. Because, I think the summary is essentially investing in core index type of exposures, beta exposures, is not really going to work in this environment. So you need to diversify, you need to get some fixed income exposure, and you need to move into some more active type of exposures for the US. And then obviously there's everything else globally that we can talk about.
And I do wonder, I know one of your sort of strategies for the US is to broaden out themes and to navigate that volatility, but is it more compelling just to take a look at some of the other non-US opportunities, given the performance divergence we've seen with China, with certainly Europe?
Yes, definitely. I mean, at the very basic level, most of our investors are benchmarked to a global equity benchmark. So, you do have around 2/3 of that exposure is in the U.S. So taking a huge underweight there is obviously a risk. But there is a broadening out happening in terms of performance and earnings growth. Equal weight type of exposure has been working quite well. That's something we were pushing since the start of the year. Financials have done relatively well. Again, that's something that we've been pushing from the start of the year. And the growth to value rotation, as I mentioned. Outside of that, Europe has been a little bit of a surprise, but there is a divergence going on between what we're expecting from the Fed and what we're expecting from the ECB. And you have the valuation differential, right? So, U.S. outperformers, there's been some profit being taken there, particularly in the tech space. Europe has been relatively cheap, and Europe is a value market. So generally, when we start to see those rotations, investors will move into Europe. So in February, we actually saw the highest inflows into European exposure ETFs since 2021. So relatively big moves there. How long that rotation will last, I think, depends on how well the U.S. economy does and how earnings growth comes through there. And then you have places like China and Japan. China specifically, as I'm sure most of your viewers know, has been a relatively narrow but pretty significant rally to the upside for some of these technology names. China is really where the money is in motion at the moment. And I think the next question is basically, do we start to see a pickup in earnings? Do we start to see a pickup in consumption? 5% GDP target is relatively optimistic. And do investors start to move more into some of the onshore names?
So for China, it's interesting because, for China, we've sort of been waiting for the big global funds to come into play with this rally as well, right? It sounds like it still depends on a broader macroeconomic environment picking up, policy support picking up, rather than it just being a very idiosyncratic, AI, DeepSeek, private tech-driven type of story?
Yes, exactly. I mean, if you look at the rally post the relative surprise in terms of PBOC announcement at the end of September, that was basically domestic type of stocks moving, which is something we don't tend to really see at the start of a China rally, because investors tend to move into the ADRs tech space where there's a little bit more liquidity and it's more accessible to overseas investors. That rally didn't last very long, and we saw a lot of that inflows moving back out. The tech rally has been a little bit more of a surprise, and that's happened in a very narrow part of the market. And so we have seen interest in things like Hang Seng Tech Index. MSCI China is a little bit broader, but not so much interest into the domestic onshore names. And in order for that interest to move back into domestic onshore names, it is primarily an onshore liquidity growth type of story, which the green shoots are there, I think, but it's going to take a little while for that earnings growth to come through, to see a pickup in consumption, downturn in terms of youth unemployment. So I think that might possibly be the next move for the China market.
There's still a lot of evidence to support enthusiasm over India, right? But when do you think that narrative, when it comes to equities, turns around?
I think not yet. So when we looked at our outlook at the start of the year, the basic view on Asia was China was the shorter term tactical trade because investors were underweight. They've been underweight for a long time. Valuations were cheap, et cetera. Japan, kind of more medium term. We've seen that broad beta rally from 2022 to the midpoint of last year. Now it's become a little bit more of an active market. You're starting to see inflation come through, growth come through, wage growth come through, but it is happening more at a bottom-up level. For India, I think the longer-term view is obviously that's going to be the growth driver of Asia, but there were some concerns about valuations and also around the participation of retail investors and some of the moves in things like warrants, futures, et cetera there. So I think the basic view is investors will buy India if it continues to cheapen, but it's been quite expensive, and I think for now investors are more interested in that India to China rotation. How long that will last, we don't really know, but I think India definitely the longer term growth mover, but I think still not quite yet time to move back in tactically.
Before we let you go, where do you see the US dollar going from here?
It looks like in the short term it will weaken. The difference, I think, for us is when you look at the expectations for Fed rate cuts for this year, now being priced at somewhere around 3 rate cuts, we actually think inflation is going to be stickier than the market is expecting. If you look at all the U.S. policies around fiscal spending, corporate tax cuts, et cetera, these are all inflationary type of policies. And so I think, in the short term, I think the U.S. dollar will continue to weaken, but I do think once the market starts to digest the fact we won't get 3 rate cuts, we might only get 1, you'll see a little bit of a pickup in U.S. dollar.
Thomas, really great to have you with us. Thomas Toll, who's the head of APAC Investment Strategy at BlackRock. One of the stocks that we're watching very closely is the reaction in Samsung SDI. Of course, we had the news in that regulatory filing that they're selling 2 trillion won of new shares. We're seeing upside about 2.25% for Samsung SDI at the moment. 11.8 million new shares on offer. According to that statement, the proceeds going towards an investment in a JV with GM, a Hungary plant expansion and investment in solid-state battery lines in South Korea, saying that they've decided to preemptively increase capital to secure long-term investment sources and to establish that stable financial structure at a time when battery demand recovers in the future, so that they'll be at a state of preparedness there. The expected new share price at 169,200 won per share, with a 68.76 million current number of shares outstanding there. They're also considering various other measures, including utilising assets for further funding. More ahead on the Asia trade. This is Bloomberg.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests.
European Commission Vice President Kaja Kallas there speaking with after President Trump, threatened 200% tariffs on the bloc's alcoholic products following the EU's plan to tax American whiskey exports. Bloomberg News desk editor Jill Desis is with us now. And so, we are in a world of really dizzying tariffs and counter tariffs and reciprocal tariffs now.
Yes, that's right, Heidi. And at this point, it doesn't really look like there's an end in sight. I mean, look, we were here 24 hours ago talking about what could be next in this escalation of these tariffs, particularly when it comes to the U.S. and Europe. Obviously, now we've got this latest threat from Trump. You're seeing on your screen right now that 200% tariff on EU wine and champagne, saying that he wants to bring things back to American producers of wine, and even said champagne there. I mean, at this point, though, he's actually already kind of telegraphed that there could be more to come, or that there at least will be more to come. I mean, there's still this April 2nd deadline that we're all looking out for, where Trump has really vowed that the U.S. would put forth reciprocal tariffs, sort of worldwide, kind of tailored to each market. So that's one thing that we're looking out for. The EU, of course, you've just heard there saying that they're going to defend our interests. It's really sort of in this trade war so far, we've really seen the EU and Canada really kind of come out with these more forceful sort of retaliatory efforts against some of these American tariffs. A lot of other countries at this point are still sitting on the sidelines, but really, I mean, at that point, it's kind of just about negotiation, figuring out next steps. I think there's still a lot more that we really need to digest and really kind of look to in the future, because this doesn't really seem to be ending anytime soon.
The great quote from the Commerce Secretary, Howard Lutnick, saying that the president is totally annoyed that the Europeans have done this, right? And plus, they've sort of picked these very iconic American product categories and brands. Is there this really a signal that countries like Canada, like groups like the EU, are not are taking a very firm stance on this, versus, as you say, some of the other nations, including Australia, Japan, South Korea, that are kind of, less willing to put in reciprocal moves?
Yeah, it is really interesting to hear, not just from Trump, but yes, as you said, as Commerce Secretary Howard Lutnick, about some of these targets. It almost kind of feels personal in some nature. Lutnick was just calling out, he's like, how could they target, Kentucky bourbon, Harley Davidson motorcycles, that kind of thing. He also actually kind of suggested that these retaliatory efforts out of Canada are because of the election coming up, and it's more about their own domestic interests than it is about anything else. I mean, obviously, that's that claim from Howard Lutnick there. But again, yes, it is, I think it's particularly interesting that you are seeing those shows of strength, sort of, that really, really aggressive response out of the EU, out of Canada. Is that a play that ultimately ends up working for them in the long run? We'll kind of have to see, but I think we have sort of enough time over the next several weeks to kind of contrast it with the strategies that we're seeing out of these other countries. I mean, I think the UK in particular, which, at this point, the PM Keir Starmer has actually had something of a fairly good relationship with Trump recently when it comes to, not just how he's interacting here, but also when it comes to, Ukraine and other measures. It'll be kind of interesting to see, whether they actually follow through with any of their own reciprocal tariffs. Again, it's really that April 2nd deadline at this point that we're looking out for to see if there's any sort of deal making that happens ahead of that, or if there's anything that kind of progresses after that deadline.
Bloomberg News Desk Editor Jill Desis there. Let's take a look at how futures in Europe are opening up at the moment, and of course, what a sort of tale of two markets, right? When you take a look at the correction territory that we're now facing or in when it comes to US equities, and really a little bit more resilience as we continue to look at European futures. We did see a bit of a dip in the previous session on account of all of the sort of tariff announcements and counter-tariff announcements. Pretty volatile session, and not unexpected. We saw beverage makers, for example, decline after Trump threatened to impose the 200% tariff on alcoholic beverages there. Watching to see how this session progresses, as we've seen a little bit of resilience in the Asian sessions so far today. But also watching geopolitics, of course. Russian President Vladimir Putin saying that he wants to discuss the proposed Ukraine ceasefire with US President Donald Trump. However, he warned that any truth should lead to a long-term resolution of the war. From all it's bringing, Bloomberg's Michael Heath. I mean, that is ideally the result of a ceasefire.
Yes, that's exactly right, Heidi. And I think that one of the reasons he might want to talk to President Trump too is that Trump, obviously holds Putin in very high regard, or is fascinated almost by him, it seems. He's very, very interested in what the Russian president is up to. And so I think that Putin probably has a sense that if he speaks with Trump, he can probably convey Russia's opinion and draw the US president around more to Russia's side than perhaps lower level officials who are a bit more versed in the day-to-day realities of what's going on there. But there is also a sense, and a lot of analysts have been saying this, that there's a bit of obfuscation going on too, that exactly as you say, what's the idea of Putin saying that it must lead to peace? Well, of course it should. I mean, that's what a 30-day ceasefire is designed to do. It's meant to give some time for negotiators to get going on a long-term solution to this, which is obviously not going to be an easy thing either.
At the same time, there's obviously a big economic stake that is always kind of back of mind, right? What are we hearing when it comes to potential joint ventures with Gazprom?
Yeah, well, that's the talk that's come out, that European officials have basically said that there seem to be some sort of contacts going on between the US and Russia in terms of Gazprom, which, for those who don't know, is this just behemoth of a hydrocarbons company, mainly focused on natural gas, and it supplied a lot of Europe, in the period up to the war, and this was one of the foundations of a strong Russian-European relationship post the Soviet Union, was these gas sales, and it was a great market for Russia. It brought a lot of revenue, and it was a secure supply for Europe, or so it had seemed. Now the supply, obviously, when it was cut off in many respects once the invasion occurred, but now there's talk that the US and Russia might be trying to do something with joint ventures with Gazprom. It's unclear how that would work, given that the US is a big producer of gas itself, but there's a lot of money involved in there, so it'd be a very, very interesting one to watch.
Bloomberg's Michael Heath there. Well, the Russian economy has endured despite Moscow's war on Ukraine and years of Western sanctions. And as Trump warms up to his Russian counterpart, Bloomberg Originals takes a look at the strength of the Russian economy.
We've really witnessed a historic shift that has changed the world order. This was the first time a U.S. president had spoken with Putin since the invasion of 2022.
That phone call between US President Donald Trump and Russian leader Vladimir Putin shifted global alliances.
You're gambling with World War III.
Even with a ceasefire on the table, US military support for Ukraine and Europe as a whole is no longer assured. That means Europe's future ability to contain Russia has become less certain. But what is clear is that over a decade of sanctions have not worked.
Russia's economy has weathered the war and sanctions much better than many Western analysts forecast.
The world and G7 applied some of the harshest measures on Russia and still hasn't been able to deter it.
Despite restrictions, Russia's energy exports have continued to power its war machine.
Russia now produces around 10.4 million barrels a day. This puts Russia as the third largest producer of oil, just behind US and Saudi Arabia.
Before 2022, India imported about 1% of its oil from Russia. It's now importing anywhere from 35 to 40% of its oil from Russia. China has been a crucial conduit for Russia to import semiconductors and microelectronics that it needs for its precision-guided weaponry that's used to target Ukraine. If India and China had been following Western sanctions, Russia would have a much harder time sustaining the war.
The Russian government has been pumping huge sums of money into the economy, both to support defense production and to support businesses and sectors that have been affected by international sanctions. The military is now competing with the civilian sector for labor and for men to go to the front. And the only way for many civilian industries to compete with that is to increase their own salaries. That stoked demand to a level that the economy isn't really able to meet. The economy has been overheating in that regard.
Overheating means inflation, which spiked in 2022. Capital controls and interest rates managed it briefly, but since mid-2023, it's been on the rise. Despite these headwinds, Russia has a lot of fiscal space.
From the Kremlin's point of view, the economy isn't the primary concern right now. Putin's focused on achieving his goals in Ukraine and achieving his goals in confrontation with the West.
I think it's inevitable that we're going to be facing Cold War-style military spending. There's going to be competition for resources.
We have to remember that this is the biggest conflict in Europe since World War II.
The stakes are enormous. Look, no one wants to spend more on weapons, but this is the new reality we face.
You can watch the full version of our weekly documentary by Bloomberg Originals, that team putting it on the terminal, YouTube and Bloomberg.com. More ahead on the Asia Trade, this is Bloomberg. Let's get to some market calls that we're following today. And President Trump's trade war chaos is leading to growing calls to lock in profits and sit on the sidelines. Roundhill Investments thinks that buying the dip now is like buying discounted tickets to a show without knowing who's performing. NFJ Investment, meanwhile, believes that this uncertainty could last for a while yet. Morgan Stanley seeing more trouble ahead for the dollar. Strategists warning that slowing growth and rising asset values abroad could drag the dollar lower in the lead up to President Trump's April 2nd tariff deadline. The bank recommends going long euro, pound and yen as investors bet on tighter monetary policy and fiscal expansion in Europe. Take a look at treasuries, where we saw the bulk of the move. Not sort of a dramatic move, but certainly investors continuing to flock to US government bonds as we see these ebbing expectations when it comes to strength in economic growth there, as well as just the sell-off that we're seeing across stocks. That rally averting a third straight daily loss that had seemed earlier quite likely. The 10 and 30 yields reaching their highest levels so far this month. But it's interesting, some of that US eco data, including the muted PPI numbers, showing slower inflation, have largely been ignored by the bond markets. The view is that this may be temporary because of the trade policy from the Trump administration and how that potentially plays out for the inflation outlook and for the Fed as well. But we continue to see yields falling and that reversal when it comes to the 10-year as well. A low volume flight to quality bond rally is sort of how we saw it. We're also dealing with the chances of a government shutdown increasing. The market sees that at about 40% there at the moment. So we continue to watch that and how much that could further react when it comes to bearish policy news from the US. More ahead on the Asia trade. This is Bloomberg. Take a look at Asian markets at the moment. We are seeing a bit of a divergent picture with some Asian equities dropping in the Friday session following the losses that we saw in US stocks overnight. These trade war barbs that continue to be traded between Donald Trump and in this case it was the EU reaction overnight as well. Seeing the S&P 500 dropping to a 6-month low, we saw that fall into the correction territory there as well. But at the moment we're seeing a bit of a split picture when it comes to trading in Asia. The Kospi is a little bit softer, but we're seeing the Kosdaq tech stocks there trading a bit stronger there. The Nikkei 225 also up by about 0.25%. We're also seeing stocks trading in Australia keeping their head above water as well, avoiding that technical correction territory, as we see some pretty strong gains when it comes to miners and utilities in particular. But broadly, we are seeing that downside pressure, of course, as we continue to weigh up really the uncertainty of the trade tariffs, as well as what's going on with some of the geopolitical concerns as well. The bright spot, of course, has been really Chinese markets. Let's get to our China correspondent, Min Lo, who joins us in Beijing. So we continue to hear enthusiasm when it comes to the rally, particularly when it comes to the tech-driven rally, right? But a lot of the sort of views from big institutionals, from global fund managers have been that we need to see that broader economic improvement.
Yes, we are seeing the hedge funds still kind of taking out or stop hedging their bullish and bets on China. But we do see the CSI, the mainland markets yesterday reversing the gains in the morning, eventually ending the day in losses. We had a weak handover from Wall Street, but still it is that rare bright spot. If you look at the A50 futures, it's up 0.2%. You look at the Golden Dragon, it's down just 0.2%, which is still pretty remarkable given the broad sell-off that we are seeing in the US. You look at some of the US ETFs investing in China, still seeing gains there. The Hang Seng, yes, we have seen daily losses so far this week. We could possibly see a weekly loss as well if that trend continues, but still that slide not as far as what we are seeing in the US amid this global turmoil. And as you said, there are a few things going for China. One is the NPC, the government work report, largely having met expectations. The tariff risks are there, but Beijing's measured response so far has been seen as a positive. And of course, there is the optimism around China's tech breakthroughs so far. And overall, the medium-term risks are still there. People still worried about whether the Chinese consumers will continue to spend, but there is increasingly this narrative taking hold that maybe Hang Seng will be the outperformer this year. We continue to see the US and Chinese stocks diverging, and you have banks like HSBC and Citibank upgrading their ratings for China stock from neutral to overweight.
What are we expecting from CATL?
Yeah, CATL is reporting its final year earnings this week, but today it has already reported its preliminary earnings, and that showed record high profits as high as a 20% rise on year. But revenue, though, had fallen below analysts' estimates. That is partly because of falling prices, falling EV demand. It's facing headwinds from geopolitical tensions to increased competition, but still, the company has shown pretty strong resilience with its new product innovations, its investment into these energy storage solutions have helped to backstop the reduction in global EV demand, and it's still staying ahead of the curve there. So even though the stock has underperformed, down about 5% this year compared to its peers, which have been seeing gains of about 11%, analysts are still pretty bullish. The price target for this stock is about 36% gain on year, and we're hoping to hear more details from CATL on its secondary listing in Hong Kong that expected to raise about $5 billion. Also more details about its overseas expansion plan, because the CATL, management has said that they are planning to have more plants in Europe with more joint ventures as well. They have already committed to invest at least $4 billion in a plant in Spain in a joint venture with Stellantis, and all of these would help to counter some of the tariff risks as well.
Bloomberg's China correspondent Min Min Lo there. Well, one of the sources of excitement ongoing when it comes to the China rally is Chinese startup Manus AI. It's created the artificial intelligence agent that has gone viral, impressed many with its capabilities. Our Bloomberg Opinion columnist Catherine Thornbeck says that this tool also reveals that Chinese startups can compete with big US tech firms in building AI products. She joins us now from Tokyo. So, of course, first it was DeepSeek. We've drawn some comparisons when it comes to Manus AI, but there's that extra excitement when it comes to agentic AI at the moment.
Right. So I think the comparison to DeepSeeks that we're seeing are sort of understandable, but there's some real key distinctions between the DeepSeek moment and the Manus moment we're seeing now. And I think DeepSeek was really about sort of technical breakthroughs, and they released their own AI models, whereas Manus, I think, is really about product innovation, and it shows that these Chinese startups can really stay competitive when it comes to releasing sort of practical consumer and business-facing products. And I think, Manus AI was actually, it didn't build its own models. It was built off of other models. For what we understand, some of Alibaba's models and Anthropic's models. But it really did this very splashy product launch that sort of echoed some Silicon Valley sort of product unveilings. And I think it really shows that Chinese startups are really sort of being very competitive in this space.
So much hype, but it's also been quite difficult for people to be able to access Manus. What was your experience in using it in terms of how user-friendly it was, and if there were sort of any glitches at this point, which we know it's not the final product at all?
Right. So as you mentioned, Heidi, getting my hands on this tool was very, very exciting. It felt like sort of scoring Beyonce tickets, just because there was so much global hype over the past week, and only about 1% of people have been able to actually access it. I did find it to be imperfect at this stage and a little bit glitchy, but at the same time, it was very, very impressive. I asked it to build me a website, and in roughly 30 minutes, it was able to deploy a temporary URL that had a bio page, a contact page, pretty much everything I'd asked for, and it did that all on its own. At other times, I found it to be a little bit slow, but I thought the interface was very user-friendly. For this agentic AI, for these AI agents, it sort of showed me every step of the process that the tool was doing, so I could intervene at any time if I wanted to. So it's obviously, still in beta mode right now, but I think it shows a lot of promise.
And it kind of shows, there's a saying about being perfection being an obstacle to progress, right? Is this an example of how if you put out something that, generates a lot of excitement, even if it's not perfect, then perhaps something that Silicon Valley needs to be learning from too?
Right. So I do think that Manus's launch sort of shows that China knows how to play Silicon Valley's game when it comes to, really creating hype. And I think, some of the scarcity and exclusivity here really sort of compounded that hype. At the same time, I think that there's a lot of questions that this new era of agentic AI sort of ushers in, whether that's how much autonomy we want to actually be giving these agents and these AI tools. But beyond that, I think that there's other lessons for Silicon Valley here. And, one thing that I thought was interesting was I felt like Manus really showed that sort of the underlying AI models and the underlying technology is really being turned into sort of commodities. And the real sort of selling point of this is the services and the practical tools that are being built on top of that. And I think that's a theme that we'll start to see play out in Silicon Valley more.
Bloomberg's Catherine Thornbeck there. More ahead on the Asia trade. This is Bloomberg. Take a look at how we're trading in Japan at the moment. We are seeing stocks just keeping their head above water, about 0.4%, despite a pretty miserable lead-in from US stocks overnight. We're watching JGBs in particular, given the bid into treasuries. We're a bit firmer today, but looks like potentially some modest moves, given that we do have the first tally of pay negotiations from the Rengo. Wage talks expected later today. So that wage inflation, as well as the implications for the BOJ, will really be sort of paramount for what we see as the further price action for JGBs there. We're also seeing implied volatility creeping a bit higher when it comes to JGB options, which could translate into a little bit more demand. Dollar yen there just shy of that 149 level, as some of the calls on the dollar, including from Morgan Stanley, start to get a little bit more dim. The worst start for the US dollar to a year since 2008. Well, Bloomberg's Japan and Korea's economy and government editor Yuko Takeo joins us now with more on these wage negotiation results. What are the expectations?
So the expectations basically are that Rengo's results will be basically the same as last year. So if you think back to last year, the highest wage negotiation results in 3 decades, basically it was a final element that pushed the BOJ to make that historical decision to exit negative rates. This year, we're roughly expecting similar levels. That means the idea of a positive economic cycle that's fed by growth, inflation, and wages, that idea will probably remain intact as long as we see the results that we're expecting for the Rengo negotiations.
What are the potential implications for BOJ policy?
So the implications for the BOJ basically is that presently we're expecting the BOJ to keep raising rates at a gradual pace, so once every 6 months or so, as long as the Rengo results remain fairly solid and we see results that are ballpark similar to last year's above 5% levels, the BOJ can continue with its gradual pace of rate hikes. Economists surveyed by Bloomberg have said that as long as the results coming above 4.4%, that shouldn't disappoint the BOJ. So that's one potential key level to watch. And another point may be whether the wage hikes hold up for part-time workers and non-regular workers. The BOJ is trying to see whether the wage hikes hold up for workers who are beyond the big companies of Japan. And as long as the wage hikes hold up for the broader economy, that shouldn't derail the BOJ's outlook for wage hikes and economic growth going forward.
Despite these hard-fought gains, multi-decade highs when it comes to wage hike gains, we're still not seeing that really translate as much into real wages, right? How much of a struggle is it to be able to keep that relationship between rising inflation and actual real wage gains a tenable one?
It's definitely a struggle. Wages have been, as you say, at fairly historical highs, 3-decade highs. But if you look at real wages, it's been going in ups. It really hasn't been holding up. If you look at last year's figures, real wages actually fell 0.3%. And it just illustrates how much inflation is strong in Japan. It's actually, at the moment, overall inflation is the strongest among G7 countries. So the struggle for the BOJ is and the government is to try and make sure that the wage hikes keep up with the strong inflation we're seeing in Japan. And that has implications for Prime Minister Ishiba as well and his support rate. But also the BOJ's planned or goals of continuing to raise rates and continue with Governor Ueda's normalization goals.
Japan and Korea's EcoGov editor Yuko Takeo there with those keenly watched wage results. Well, AIA will start a $1.6 billion share buyback, which its CFO says reflects strong momentum in the business. Garth Jones spoke with us a little bit earlier.
We saw an excellent set of results by any measure in 2024. We saw double-digit growth in our key metrics for new business growth, for earnings, and for cash generation. Our value of new business, our key growth measure, grew by 18%. And importantly, we had double-digit growth across all our market segments. It's a broad-based growth. Our operating profit after tax was up 12% per share, and our underlying free surplus generation also grew by double digits. So with that, we've seen an increase in the final dividend of 10% per share, and as the headline says, a $1.6 billion additional share buyback. I think that reflects the strong momentum in the business. We've seen growth across the portfolio. We've seen recruitment be very strong in the agency force. Recruitment was up by 18% in 2024. And with that, we see the strong momentum building into 2025. So we remain confident in the outlook, and we're very well placed to capitalize on all the opportunities available to us.
Can you tell us about how the China part of the business is going, how margin expansion is looking? Last year was pretty good, and what sort of expansion and strategic plans do you see for China?
Yeah, we're obviously very excited about our China business, which goes from strength to strength. We have a differentiated business in China, which is focused on the wealthiest parts of the geography, the biggest cities in China, and also the wealthiest segments, the more affluent customers. That makes them more resilient through economic cycles. Our business is also very well diversified. More than half our earnings come from insurance and fee-based sources, and our business is focused both on protection and long-term savings. So what we've seen is growth in the agency force again. The agency grew. Recruitment has been strong. We've seen growth in the number of new customers, and the business is going from strength to strength over time. Importantly, we've also seen growth in our geography. We started off with our original 5 geographies, which continue to grow, and we've deepened our presence there. We had 5 new geographies from 2019. They've been growing very well. They grew at 27%. The business overall grew by 20%, so you can see they're growing even faster than the rest of the portfolio there. And our new businesses in the provinces we've just been awarded. We were awarded 4 new provinces in 2024, and we're just starting operations there. So you can see there's tremendous headroom for growth in China. We remain extremely excited about the prospects there.
Garth Jones, Group CFO for AIA. Some of the other corporate stories that we're following this hour on World Liberty Financial, one of the Trump family's crypto ventures, is said to be in discussions with Binance about doing business. Sources say conversations have included the development of a stable coin with World Liberty. According to its founding documents, the Trumps received 3/4 of the venture's net revenue. Alibaba has unveiled a new version of its AI assistant mobile app, Quark, which incorporates its latest in-house reasoning model. It now integrates functions including a chatbot and a task execution. New Quark will be available to all users gradually, starting with a pilot launched on Thursday. Tesla warned that the US government warned the US government, I should say, that retaliatory moves by other countries could drive up costs and make its cars less competitive. It expressed concern about the tariffs' impact on its supply chain. In fact, Canada's third most populous province, British Columbia, pulled government subsidies for people to install Tesla chargers. BC Premier David Eby said the move is targeted at Tesla CEO Elon Musk, who is one of Trump's biggest backers. Bloomberg has learned the operator of retailer Forever 21 is preparing to potentially close down its stores as part of a bankruptcy filing in the coming days. Sources say efforts to find a buyer for the fast fashion retailer to avoid a liquidation have failed so far, but talks with one potential bidder are ongoing. At its height, Forever 21 operated over 500 locations in the US, with at least 800 worldwide. More ahead on the Asia trade, this is Bloomberg. Just some breaking news crossing the Bloomberg when it comes to Citi and Apollo testing out a new private credit tie-up in relation to this, in terms of what they're offering to potential buyers of Boeing's Jeppesen navigation unit. This is the option to fund the acquisition via their private credit partnership. That sale could mean approximately $7 billion for Boeing. Debt financing estimated to come between $3 and $3.5 billion US dollars. A major test really to be seen when it comes to this Citi Apollo partnership, which was announced just last year, in addition to its ability to win over a buyer with a supporting financing package there. So this would be the first private staple financing, according to a person familiar with the matter. It's a form of pre-agreed funding used to facilitate an acquisition. It doesn't guarantee that the bidders who accept it will win the deal, and buyers can still choose to use other lenders instead. But we have seen Citigroup and Apollo agreeing last year to work together on $25 billion worth of deals over the next 5 years, with Citi sourcing new financing opportunities and Apollo providing the cash for that. And in the meantime, we're hearing that the carve-out of Jeppesen has entered the second round of bids, according to people familiar. We're hearing the likes of RTX Corporation, Honeywell have evaluated Jeppesen. Buyout firms including Carlyle, Thomas Bravo and Warburg Pincus, amongst others, have shown interest in that business as well. We'll bring you more as the details get to us, but in the meantime, let's take a look at how commodities are reacting, given, of course, these really ongoing global trade tensions, the back and forth between Donald Trump and the EU, and how we see that really sort of being played out there as well. This is a picture when it comes to Brent crude. We've seen some oscillations there, pairing ultimately the weekly loss, which is a bit of a change when it comes to the downward trajectory for crude prices. These new US sanctions against Iranian oil and shipping countering some of the fallout in the slump following a pretty bad demand forecast from the AIA. We're also watching gold as well, another fresh record high as these economic fears continue to see that haven demand. Well, the EU's top diplomat, Kaja Kallas, says the European Union is ready to defend its interests. She spoke with Bloomberg after President Trump threatened 200% tariffs on the bloc's alcoholic products following the EU's plan to tax American whiskey exports.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests. But like I say, in the end, eventually the consumers get to pay higher prices, and that is not in the interest of anybody. So we really try to avoid these things, but of course we see this news coming all the time. I think right now is important to keep cool heads, because we see the statements, and then what really matters is the actual steps, the legal acts that are done, and then we are also ready to react.
A stupid question or a basic one, but are you confident you know what the U.S. wants when it comes to this trade war? As you watch all of these salvos and escalations, do you know what you could do or might do to appease the President of the United States and end the war that started a few weeks ago?
Well, of course, you have to ask the President of the United States what is their goal regarding this. But what they have been or what they have been saying out is that there is a trade deficit between our countries. It is of course not that big, and we can address this in a different way. But it is how it is. Like I say, we keep a cool head, and of course we are ready to act and defend our interests when we need to.
The European Commission's Vice President and High Representative for Foreign Affairs and Security Policy, Kaja Kallas, there with us earlier. Take a look at the setup when it comes to US futures, looking a little bit more positive, but of course this after the S&P 500 slipped into correction territory as we continue to see that stock market downside from these ongoing trade bombs being exchanged. Of course, we were just talking about the threats when it comes to European alcohol that are the latest to come from the Trump administration.